Although Christmas is getting ever nearer, there'll still be plenty for followers of financial markets to ponder in the coming week. After the Fed and the fallout from the UK's general election last week, this time around the macroeconomic headlines are likely to be hogged by two more central banks. The Bank of Japan and the Bank of England are both due to announce their latest policy decisions on Thursday the 19th of December. Now, neither is expected to make any changes, although there may be a chance the Bank of England looks to act in the wake of the general election result, just as it did in the wake of the EU referendum back in June and August 2016. Remember, the Bank of Japan's policy has got three main thrusts. A headline interest rate of minus 0.1%, yes, minus 0.1%, a quantitative easing or QE scheme worth 80 trillion yen a year, as it buys Japanese government bonds, shares in real estate investment trusts and equity exchange traded funds. Now that's the equivalent of £560 billion a year compared to the £435 billion programme run by the Bank of England over the last 10. And also thirdly, a plan that the BOJ calls qualitative and quantitative easing or QQE, whereby it looks to cap the yield on the 10-year Japanese government bond at 0.1%. This chart here shows the headline interest rate and the Bank of Japan's balance sheet since the financial crisis. Have its policies worked? Some would argue yes, because Japan's economy is growing and its stock market has generally lapped it up. Others would say no, and the counter-arguments based on how Japan is still relying on these emergency crutches, inflation's below target, and the government is having to launch yet another fiscal stimulus package to try and boost growth. The Bank of England's following a similar path, with what you could argue are perhaps similarly mixed results. Growth is patchy and inflation barely on the 2% target, so expectations of this cycle's third interest rate increase from the old lady of Threadneedle Street have faded away. A lot more may depend on what happens after the election, especially in terms of Brexit, but at this meeting the Monetary Policy Committee is expected to leave interest rates unchanged at 0.75% and QE unchanged at £435 billion. The main point of interest, therefore, is how the MPC votes. Last time it was 7-2 for no change, but committee members Jonathan Haskell and Michael Saunders both voted for a cut in rates to 0.5%. That ended a run of 9 straight meetings back to September 2018 that have voted unanimously for no change. So we maybe can see the direction of travel shifting towards a cut. Now on the company front, news flow is starting to quieten down, but keep your eyes peeled for those firms who may try and slip out a profit warning in the hope that everybody's too busy with Christmas to look. We've also got a few scheduled sets of interim and final results or trading statements and general meetings to track in the week ahead, including those from Aerospace and Defence Group Chemring on Monday the 16th of December, FTSE 100 support services firm Bunzl, Trainline and oil equipment and services specialists Hunting and Petrofac on the 17th, WH Smith hosts an EGM on the 18th, as does gambling services group Playtech on Thursday the 19th. But the biggest source of fuss in the week ahead could just be Carnival's full year results. The cruise ship operator is due to publish them on Thursday the 19th of December, although do note that date is still subject to change. As we can see here, the shares have pretty much sunk without trace over the past 12 months. This is because the firm has dished out profit warnings in March, June and September, and they've trimmed earnings per share forecasts for the year ending November from $4.66 a year ago to around $4.26 now. In addition, the stock's ratings dipped from 16 times forward earnings to 12 to 13 times, reflecting concerns over the cycle and the increased volatility of profit forecasts. Now, Carnival has cited several factors for the earnings downgrades of the past 12 months, including, by no means comprehensively, technical problems with the Carnival Vista vessel, America's latest travel restrictions with regard to Cuba, higher fuel prices, and a $20 million fine from the US authorities for dumping oily waste into the sea. For those of you worried about Carnival's environmental, social and governance or ESG record, do note that over the past 5 years the firm has launched a dozen state-of-the-art ships and retired 9 older craft. In addition, a further 17 new launches are scheduled for the next 5 years, and the new ships should be a lot greener and a lot more fuel efficient. When it comes to the numbers though, the first figure to watch will be that headline earnings per share or EPS figure. As already mentioned, for the full year, the analyst consensus is $4.26 a share, flat on last year. Also watch out for the dividend. The company so far paid out 3 quarterly dividends of 50 cents apiece, putting it on track to match last year's $2 a share full year payment. That's enough for a yield of just over 3.5%, with earnings covering the dividend by more than 2 times. We can see the full year dividends history back over a decade, with earnings cover shown as well here. Also note that Carnival is running a share buyback program at the same time. As a final point, analysts will be watching out for any guidance for the year to November 2020. Key variables to note include capacity growth, where Carnival's current plan is an increase of around 7%, net revenue yields, pricing and occupancy rates, currency movements, especially with regard to the dollar, and again, fuel costs, so watch the oil price. At the moment, analysts are expecting a modest 3% increase in earnings per share to $4.40. Thank you for watching, and I look forward to seeing you next time.